Market discipline, its role and mechanisms in financial markets, exploring the impact of market discipline on finance. Agenda Introduction to market discipline, mechanisms of market discipline in the banking sector, challenges and limitations, future directions and improvements. Introduction to market discipline defined. Market discipline is the effect of market forces on the actions of financial institutions, shaping their behavior significantly. Encouraging ethical conduct. Market discipline promotes ethical behavior among financial institutions, fostering trust and transparency in the financial system. Efficient operations. By adhering to market discipline, financial institutions can achieve more efficient operations, leading to better resource allocation. Risk management. Effective market discipline encourages robust risk management practices, ensuring the stability of the financial system. Historical background Response to financial crisis. Market discipline has historically evolved as a direct response to various financial crises, influencing regulations and practices. Accountability and transparency. The push for greater accountability and transparency has shaped the mechanisms and practices in financial institutions, enhancing trust. Reinforcing market discipline. Various mechanisms have been developed to reinforce market discipline, ensuring better compliance and risk management in finance. Key components Transparency. Transparency in financial operations allows stakeholders to assess crucial information and make informed decisions. Accountability. Accountability ensures that financial institutions are held responsible for their actions and decisions, fostering trust. Flow of communication and information. A seamless flow of information allows for effective communication and assessment of risks associated with financial performance. Market signals and information flow. Stock price movements. Stock price movements are key market signals that reflect investor sentiment and provide insights into a company's performance. Credit ratings. Credit ratings indicates the creditworthiness of financial institutions, guiding investors in assessing risk and making informed decisions. Information flow. Efficient information flow in the market is essential for transparency, allowing investors to monitor and assess institutional accountability. Role of stakeholders and market participants. Importance of stakeholders. Stakeholders, such as investors and customers, are crucial in shaping market dynamics and ensuring accountability among financial institutions. Influence on financial behavior. The actions and expectations of stakeholders can directly influence operational behavior of financial institutions, promoting ethical practices. Promoting transparency. Stakeholders help promote transparency in financial markets, which is essential for trust and stability in the economy. Risk management practices. Effective stakeholder engagement fosters sound risk management practices, ensuring the long term viability of financial institutions. Regulatory frameworks and policies, rules and guidelines. Regulatory frameworks create essential rules and guidelines that oversee the functioning of financial institutions globally. Enhancing market discipline. Effective policies promote market discipline by ensuring adherence to transparency and accountability among institutions. Banks' transparency and disclosure requirements. Importance of transparency. Increased transparency in banking allows stakeholders to make informed decisions regarding financial institutions. Market discipline. Disclosure requirements promote market discipline, encouraging banks to operate responsibly and efficiently. Risk evaluation. Accessible financial information enables stakeholders to assess the risk and performance of banks effectively. Impact of market discipline on bank behavior. Encouragement of prudent risk taking. Market discipline encourages banks to engage in prudent risk taking to ensure long term stability and profitability. Discouragement of excessive risk. Effective market discipline discourages banks from taking excessive risks, thereby safeguarding the financial system. Attracting investors through transparency. Transparent banks tend to attract more investors and maintain customer trust, fostering a stable banking environment. Barriers to effective market discipline. Lack of transparency. Lack of transparency can create uncertainty and distrust among market participants, reducing effective market discipline. Insufficient information. Insufficient information limits stakeholders' ability to make informed decisions, undermining market discipline effectiveness. Inadequate stakeholder engagement. Inadequate engagement with stakeholders can lead to misaligned interests, hindering effective market discipline outcomes. Information asymmetry and moral hazard. Understanding information asymmetry. Information asymmetry happens when one party possesses more information than another, leading to inefficiencies in decision making. Moral hazard explained. Moral hazard occurs when institutions take on excessive risks due to an imbalance of information impacting their accountability. Challenges for market discipline. The presence of information asymmetry poses a significant challenge for enforcing market discipline and accountability among institutions. Regulatory and market failures. Impact of regulatory failures. Weak regulations can lead to a lack of accountability among financial institutions, fostering an environment for risky practices. Market discipline undermined. When market discipline is compromised, it encourages reckless behavior, putting the financial system at risk. Need for effective regulation. Implementing robust regulatory frameworks is essential to ensure financial institutions operate responsibly and mitigate risk. Enhancing transparency and accountability. Importance of transparency. Transparency is essential for maintaining market discipline and ensuring all stakeholders are well informed about financial practices. Building trust. Providing clear and comprehensive information helps to build and maintain trust among stakeholders in financial institutions. Encouraging responsible behavior. Transparency encourages responsible behavior by ensuring that stakeholders are aware of the implications of financial decisions. Innovations in regulatory approaches addressing market challenges. Innovative regulatory approaches are essential for tackling the challenges facing market discipline effectively. Technology in regulation. Utilizing advanced technology can significantly enhance monitoring and enforcement of compliance among financial institutions. Data analytics impact. Data analytics provides insights that can improve regulatory oversight and ensure adherence to compliance standards. Global perspectives and harmonization. Importance of harmonization. Harmonizing regulatory standards helps ensure consistent market discipline and reduces discrepancies across borders. Collaboration among countries. Collaboration among nations enhances regulatory oversight, promoting stability in the global financial system. Stability in financial systems. Effective oversight through harmonization can lead to increased stability in financial markets and systems worldwide. Conclusion. Importance of market discipline. Market discipline is essential for ensuring the stability and health of financial markets and preventing systemic risks. Understanding mechanisms. Understanding the mechanisms of market discipline can help stakeholders enhance accountability and performance within financial systems. Future directions. Exploring future directions for market discipline will guide improvements and foster a more resilient financial ecosystem. Thank you.